Okay, let's talk about a situation that's, unfortunately pretty common. Financial reality hits hard, you're a homeowner, and suddenly you owe way more than your house is actually worth.
Yeah, that's a tough spot. Utterly paralyzing sometimes.
Exactly. You need a way out, something short of foreclosure, and then you hear this term, short sale.
Right. It gets thrown around a lot.
It does, and it sounds, almost simple. Sell for less, bank forgives the rest. But the reality, well, it's messy. Really messy. Slow, risky even.
Definitely not straightforward.
So today we're doing a deep dive. We want to cut through that confusion, get to the raw facts of how these things actually work.
Good plan. There's a lot of misunderstanding out there.
Our goal here is really to give you a shortcut to understanding the real mechanics. And for this, we're unpacking insights from the mechanics of real estate short sales, which draws heavily on the great work by Don and Susie Karstedt over at Rethinking Real Estate in Lake Tapps, Washington. Really solid stuff.
Yeah, they know their field. So the basic definition, like you said, sounds simple. A short sale happens when the house's market value is less than what's owed on the mortgage.
Okay.
And the seller goes to the lender, the bank, and asks them to accept that lower sale price as full payment.
Forgiving the difference, the shortage.
Exactly. The whole point is trying to get the lender to forgive that gap to avoid going into foreclosure.
And boom, right there. That's the absolute core of it, isn't it? It all depends on the lender agreeing.
100%. The bank has to agree to take that financial hit. They hold all the cards.
And they won't even start looking at anything until you bring them an actual signed offer from a buyer, right?
That's the kicker. You can't just ask hypothetically. You need a real deal on the table to even begin their bureaucratic process.
Which leads us straight into probably the biggest misconception we need to tackle. People think, can I get my short sale pre-approved? Can I call the bank, get a number they'll accept before I list? What's the reality?
Yeah, that's a big one. And the answer is basically no.
Yeah.
That idea of a pre-approved short sale just doesn't really exist in practice.
Why not? Seems logical to ask first.
Because the lender won't operate on what-ifs. To even kick off their review process, they need two things hitting their desk at the same time.
Okay, what are they?
First, that signed purchase offer from a real buyer.
Yeah.
That sets the market value they're working from.
Right. The concrete number.
And second, they need the seller's full hardship package. They need the offer and the justification simultaneously.
Okay, let's talk about that hardship package. That sounds intense. What's actually in it? How deep are they digging into someone's personal finances?
Oh, it's exhaustive. And it really needs to be. They have to prove this isn't just, trying to ditch a bad investment conveniently.
They need proof of genuine hardship.
Exactly. Real insolvency or an unavoidable financial crisis. We're talking detailed financial statements, tax returns, usually a couple of years' worth.
Wow.
Bank statements, recent pay stubs, the works, and crucially, a detailed letter explaining the hardship itself.
What kind of hardship qualifies?
Usually things like documented job loss, a major drop in income, divorce, maybe significant medical bills piling up, or a death in the family that impacted finances.
And it has to be documented, right? Not just saying, I lost my job.
Absolutely. Verifiable proof.
Okay.
The source material from the Karstedts really emphasizes this. If it looks like the seller just, spent recklessly or is trying to pull a fast one, that package gets denied fast.
So the bank needs solid proof that foreclosure is pretty much the only other option.
That's the goal, yes. They need to be convinced this is the necessary path for the seller.
Okay, let's switch gears a bit. Think about the buyer. I'm out there looking for a deal. I see a short sale. The seller accepts my offer. Why is this still considered such a huge gamble for me, the buyer?
Yes, the buyer's perspective. This is where it gets really interesting.
Because the seller accepting my offer doesn't actually mean much yet, does it?
Not in terms of the bank's decision, no. That acceptance is just the signal for the bank to start their process.
And they don't just take my offer price at face value.
Definitely not. Once they get your offer, they'll order their own valuation. Usually something called a BPO, a broker price opinion, sometimes a full appraisal.
Okay, so they get their own number.
Right. And if the bank's BPO comes back way higher than the price you offered and the seller accepted, well, the bank has basically zero reason to approve your deal at that lower number.
So that's when the bank might come back asking for more money, even after months of waiting.
Exactly. It's off of the bank, not the seller, who issues a counteroffer. They'll say, we need X amount based on their internal valuation, their BPO.
So the buyer waits potentially months only to find out they need to pay more, or the bank just says no, or... What else can go wrong for the buyer?
Oh, plenty. The lender might just ignore the offer for months. Seriously, it can sit there. They might add unexpected fees at the last minute. Or, like you said, just give a flat no after all that time.
And the timeline itself, how long are we talking realistically?
Even if things go, let's say, relatively smoothly, you're typically looking at 60 to 120 days. That's 2 to 4 months, minimum.
2 to 4 months, wow.
And that timeline often gets longer, much longer sometimes.
What makes it take even longer?
If there's a second mortgage on the property, for instance, or if there's private mortgage insurance involved, or other liens, like from the IRS or an HOA.
Because everyone has to agree.
Every single party with a financial stake has to sign off on the short sale terms. Each one adds another layer of negotiation, another potential delay point, weeks, even months per party.
That long wait time itself sounds like a huge risk. Deals must fall apart just because people get tired of waiting.
Absolutely. That's a major factor. Buyers find other houses, their loan commitments expire, their life circumstances change. Markets can shift during that wait too.
So the value proposition might change while you're stuck in limbo.
Exactly. Or paperwork gets lost in the shuffle at the bank. It happens. Or, and this is a real nightmare scenario, the lender might actually sell your mortgage debt to a completely different bank mid-process.
No. Does that happen often?
It can, and if it does, the whole process often has to restart from scratch with a new bank, new BPO, new hardship review, back to square one after months of waiting.
Unbelievable. Okay, let's bring it back to the seller. Let's say they actually manage to navigate this minefield, they get the short sale approved, they avoid foreclosure. What's the aftermath for them? Credit impact first.
Well, the credit will take a hit. There's no way around that.
Yeah.
A short sale will lower the credit score.
But it's generally considered better than a full foreclosure.
Really, yes. Foreclosure is usually more damaging and stays on the report longer. So in that sense, it's damage mitigation.
Oh, okay. What about getting another mortgage down the line? How long does that impact last?
It's still a significant event. Even if the seller keeps all their other credit perfect after the short sale, they're likely looking at waiting probably 2 to 3 years before they can qualify for another conventional mortgage.
2 to 3 years, okay. That's substantial, but maybe manageable compared to foreclosure fallout?
Potentially, yes. But there's another risk, often hidden, that we absolutely have to talk about.
Okay, what's that?
Taxes. The tax consequences.
You mentioned the bank forgives the difference in debt. That sounds good. Too good.
It can be. If the bank cancels, say, $80,000 of mortgage debt you owed them, the IRS might view that $80,000 of forgiven debt as taxable income to you.
Wait, seriously, income, even though you never actually saw that money.
That's the potential trap. It's called cancellation of debt income.
Mm-hmm.
And suddenly, you could be facing a massive, completely unexpected tax bill the following April.
That is brutal, an absolutely crucial piece of information.
It is. And this is precisely why the source material, the Karstedt's work, is so insistent on this point. This is a talk to a CPA or a qualified tax attorney before you sign anything moment. Absolutely mandatory.
Are there exceptions, ways around that tax liability?
There have been, yes. Things like the Mortgage Debt Relief Act have existed, offering temporary protection in certain cases, like for a primary residence. But those laws expire, they get renewed, they change. Relying on an expired or poorly understood exception without professional advice is playing with fire. Financial Russian roulette, really.
So you could trade avoiding foreclosure for a 5- or 6-figure tax debt if you're not careful.
Precisely. It's not hypothetical. It's a real structural part of debt forgiveness that needs expert navigation based on your specific situation and current tax law. It completely changes the calculation for the seller.
Okay, so managing the potential tax hit, dealing with that intense hardship package, the long waits, the buyer negotiations, this sounds incredibly complex, which brings up another question. Can just any real estate agent handle a short sale effectively?
Oh, absolutely not. No way.
It seems like it would require some very specific skills.
It does. The sheer volume of paperwork, the sensitivity of it, the constant follow-up needed with the bank's bureaucracy. It's a level of specialization most general agents just don't have or frankly don't want to deal with.
What kind of specific expertise are we talking about?
Well, first and foremost, they need to know how to talk to the bank's loss mitigation department. That's who handles short sales.
And that's different from talking to a regular loan officer.
Completely different world. A loan officer wants to close deals, make loans happen. Loss mitigation's job is purely to minimize the bank's financial loss on a bad loan. They are inherently resistant negotiators.
So the agent needs a different approach.
Yes, they can't just rely on charm or standard sales talk. They need to understand the bank's internal formulas, submit documentation exactly how loss mitigation wants it, use very specific formal language. Otherwise, the file gets kicked back or buried. They're gatekeepers.
Makes sense. What else does a specialist agent need?
They need incredible organizational skills, systems really, to
Hmm.
track all the moving parts, the deadlines, the constant communication streams with the bank, the buyer, potentially second lien holders.
And keeping the buyer engaged during that long wait.
That's huge. A good short sale agent has strategies to manage the buyer's expectations, keep them informed, and frankly, keep them from walking away out of sheer frustration when the bank inevitably delays things or comes back with a high counteroffer.
Okay, so if we try to boil all this down,
Sure.
what's the final verdict? The value proposition for someone listening, whether they're thinking of selling or buying a short sale.
Well, for the seller who's really facing foreclosure, a short sale, despite all its headaches, can still be a critical lifeline.
Right. It's a structured way out that minimizes the credit damage compared to foreclosure.
Exactly. Even with the tough process and the absolute necessity of getting that CPA or attorney advice on taxes, it's often still a better path than just letting the foreclosure happen.
Okay. And for the buyer.
For the buyer, it really is the definition of a high-risk, potentially high-reward situation. You're gambling your time, months, maybe half a year or more.
Gambling that the bank's valuation matches your offer,
Okay.
that the seller's paperwork is perfect, and that the bank actually says yes eventually.
Precisely. You might get a property for a good price, but the chance of a very long delay followed by a denial or a counteroffer that kills the deal, that chance is significant, very real.
So the big takeaway here, drawing from the Karstedt's insights, seems to be the absolute necessity of having the right team, the right experts.
Couldn't agree more. The right people in your corner, as you said.
Whether you're the seller putting together that incredibly detailed hardship package and navigating tax implications, or the buyer trying to stay patient for months, you need specialized advice, flawless paperwork, and definitely an agent who knows how to speak that specific language of the loss mitigation department.
It's not a DIY situation at all.
Which brings us to a final thought, something for you, the listener, to maybe mull over. Since we've established, and the source material really stresses this, that successfully navigating a short sale pretty much requires specialized help, a specialist agent, a CPA, maybe an attorney.
Right. Multiple professionals just to manage the process.
What does that necessary investment in all that specialized expertise tell you about the inherent financial fragility, maybe, and the sheer administrative complexity built into the short sale system itself?
That's a provocative question. Think about how many expensive gatekeepers are needed just for someone to essentially lose money but do it in a structured way. What does that say about the system?